on the show today, we've got two viewer queries. Let's bring them on.
Hi, I'm a working professional. I'm not too comfortable investing in equities or equity mutual funds. Given where inflation is right now, the real rate of return on most of my debt instruments is negative. Now suggest me a way that I could save my principal.
Right. Shantanu, you want to go first?
Yeah, I think your point about the equity markets is well taken, and we do understand that there are a lot of people who may be averse to a large amount of appetite or investments in equity. Rates at this point of time, the way they are, could be seen to be marginally lower than the nominal rate of inflation. However, what one needs to see is that you need to at least protect some part of that capital, and the debt investments that you could make, say in relatively safer debt funds like cash funds or like fixed maturity plans, will definitely give you some returns, if not returns to beat your inflation rate and preserve your capital.
To look at the nominal interest rate today and compare that against what the inflation rate is today and say, inflation is higher or lower than the nominal rate may not necessarily be the correct argument. However, I think it is a known fact that there is inflation in this economy, and therefore a certain part of your returns are going to get eaten away by inflation. That's reality, and therefore you have to contend with that. So therefore you have inflation on one side and the volatility of the equity markets on the other side. There is only one way to sort of fix that. You need to increase the investment horizon that you have, which means that you have to invest in equities not for the next 1 year or the next 2 years, but for the next 3 years and beyond. And two, typically the equity returns over a longer period of time are better than fixed income. So the probability that over a 3 to 5 year period he will beat inflation as well is high. So if he thinks of his investment from a slightly longer term perspective, I think both his concerns will get addressed.
All right. I'd just like to add one point there. I think while what Rajiv says in terms of the long tenor returns on equity may be true, we also have to remember that if you were invested today, if you had invested your money at the time of the financial crisis or just before the financial crisis, from an index perspective, you still haven't made up your money. So that was 2007. You've already been 4 years into since then.
Yeah, still negative.
And you're still negative return. I mean, you could hold on and say I'll get positive returns in the next 2 years. But does every investor have that sort of an appetite and that sort of a stomach to take a significant portion of his wealth locked in at negative mark-to-market returns?
All right, we've got one more query on the show. Let's bring that on as well.
Hi, I'm 27 years old and I work with a private firm. Basically, there's been a lot of deregulation in the interest rates on the savings account, and a lot of banks have been approaching me with high interest rates. And I'm actually wondering whether I should switch over to those banks. Would it actually benefit me or not?
All right, now this is on the savings rate deregulation, the fact that some banks, at least 3-4 banks, have come out offering significantly higher rates, as much as 50% more as one ad goes. What would you advise them?
I think the savings account is a transactional account. If you look at my savings account, for example, I've hooked my EMIs onto it, so it automatically gets paid. My MTNL bill gets automatically paid, and so on and so forth. So I think I look at it as a transaction account, and so therefore I have my very, very short-term surpluses in the account. I'm not really concerned too much about whether I make 4 or 6%. I don't think my life is going to dramatically change whether I make 4% or 6%. So I think it is about the comfort that the bank is giving you. It's about the facilities that the bank is giving you, and not necessarily about the interest rate that you're getting on the fixed on the savings account. If rate is something that is of concern to you, you shouldn't leave money in the savings account. You could use mutual funds, like we discussed. Liquid mutual funds today are giving you 9%, right? Or you could lock your money away in a longer term FMP or fixed maturity plan that Shantanu was talking about. Your returns would be better. Or if you really think that you can think slightly longer term, put some money away into equities. So I think the savings account is a transactional account, and you should think of that as so, and it's not a investment instrument.
Sure. And, Shantanu, picking up on the point that Rajiv just made, the fact is if you have a 1 lakh balance in your account and 4% goes to 6%, you just stand to gain about 165 rupees a month.
That's
so
right.
Is it worth it?
Exactly. I think it brings you back to the point that Rajiv was really making, is that your savings account is a transactional account, and what you really need to see is what are the services that the bank is offering you. Are these services what you really want from the bank? Are they fulfilling your requirements on the transactional side? Do they give you the convenience of, say, whatever it is, the way that you want to bank with them, either online or through a brick and mortar branch? Is that branch close to you, and therefore would you like to be with them? So these are the things that should govern your choice of which bank you should be for your savings account. Like Rajiv said, I think if return is your consideration, then there are far better avenues of actually sweating your money better than trying to switch banks for the sake of your savings account. And just think about the administrative headaches that you would have. For example, like Rajiv mentioned, an EMI being debited to his account. Are you going to, if every time a bank is going to offer you 1% more, 2% more, are you going to go through the administrative headache of actually switching all these instructions, all your standing instructions from bank A to bank B? Clearly, that's not an efficient way of dealing with things.
All right, Rajiv and Shantanu, thanks very much for coming in on the show and helping our viewers understand debt as an asset class in India. The way you've had it, debt as an asset class may not give you the sort of returns that equity does over the long term, but it does help protect capital. It does help it does give you predictability as far as returns go. Thanks very much for coming in on the show.